What a December it has been. Another record day on Wall Street. All three major averages closing at new all-time highs. The NASDAQ 100 up 35% this year. The S&P 500 up 27%. But Cherneska says, enjoy those records while you can, folks, because they are likely not here to stay. Let's bring in Joe Zidle. He is Blackstone's chief investment strategist. Joe, thanks for coming on.
Thanks for having me.
Are you just going to are you pulling the ice bucket
call him
challenge?
Jay-Z, by the way. Just so
Jay-Z?
you know, he's Jay-Z.
Is that okay with you?
For the record, I was Jay-Z before Jay-Z was
You were.
Jay-Z.
Which is
Well, the subways in Brooklyn that are together was that before either of you. Here we go. Are you going to do the ice bucket challenge on this rally? I mean, are you throwing cold water on it? Is this all she wrote?
Unfortunately, I think I'm going to have to, because if you think about 2019, it was a year where every single macro risk was thrown at this market, right? You had a Brexit deadline that came and went. You had trade war intensify. You had a manufacturing recession, an earnings recession, yet markets didn't care. Why? Because 2019 was the year of the central banker, right? In other words, central banks had the biggest pivot that we'd ever seen. They went from balance sheet tightening to balance sheet expansion. Hiking rates to cutting rates. We had more central banks cut rates in 2019 than any time since the great financial crisis. So we look at 2020. I'm willing to bet there's going to be some macro risks. I can think of two, trade and Brexit. We haven't heard the last of them, but what's the policy response going to be? We're not going to get this massive pivot the way we got in 2019. The Fed has said that they're on hold, right? And we might get some incremental balance sheet expansion or whatever else, but we're not going to have this massive policy response we saw in 2019. I think we have to prepare for volatility.
Okay, fair enough. But, the old adages, right, guys? I mean, don't fight the Fed and don't fight the tape. Yep. Both appear to be pushing the market to new highs every day. Why would that suddenly stop with the rollover in a calendar?
No, I think it's a good point. I don't know when we're going to see this volatility over the course of the last couple months as we move closer and closer to price targets that we'd had on the market. I thought it would start to kick up. What we underestimated was really this massive policy response. But do you get your same bang for your buck when you go from $23 trillion in debt to $24 trillion, or globally when you go from $255 trillion in debt to $260 trillion? There's diminishing returns there. At some point, you have less and less of a policy response, but you still face the same headwinds. I think it's going to create volatility. There are 10 stocks today that are 23% of the market cap of the S&P 500. It's the highest concentration that we've seen since the mid-90s, and then before that, you got to go back to the mid-60s. That means there are some opportunities of under-owned stocks, under-owned sectors, and I think there'll be buying opportunities. I just don't know that it's concentrated in the Big Ten.
So what are your thoughts about earnings for next year? Because if they're there, right, and rates don't move, we could see a market continue higher.
I think that's the optimistic case. My guess is that we've probably seen the bottom on the 10-year Treasury yield, so I think the yield's going to move higher. There's inflationary pressures that are kind of emerging from a lot of different corners today. One of them is wages. When you look at wages, they're continuing to move up. Look at the production non-supervisory, right? These are your rank-and-file employees. They saw wage gains in the most recent jobs report that we haven't seen since September of 2008. And their labor markets are only getting tighter and tighter. Right? Earlier a segment, we were talking about Boeing, how they're reluctant to lay off or furlough employees, and they don't want to see that in their supply chains, because the ability to find qualified workers is so difficult today. Companies don't want to let go of them. Employees know their value. They're extracting higher and higher concessions, i.e. wages, wage inflation, housing inflation. These are pressures that I think are going to push the 10-year Treasury yield up higher. It's just generally going to be a more difficult environment for valuation. We'd like to see the earnings growth. My guess is it's probably less than where the street is today.
But, Joe, so reluctantly, though, give us your silver lining, at least in those sectors that have underperformed or lagged that you think could do okay. And you're not sure when, but it sounds like you think the Fed is at least on hold. And to me, a Fed doing nothing right now in the economy that's going to print 1.5% to 2% is a windfall. So where can you get excited?
Yeah, well, so the Fed has told us that they are on hold. I don't even think it's much of a guess, because the Fed is doing their best to telegraph this. There are a lot of companies out there that are cyclical, but still insulated from global trade, right? And you see those a little bit more in like the small and mid-cap space here in the United States. You've also seen this sort of real strong defensive rally in 2019, where some of your dividend payers ended up being sort of the most overvalued companies on a relative basis. So I think anything that's outside of those top 10 leaders is fair game. But you've got to do some fundamental work, because we're simply not going to have this sea of liquidity out there.
We got to wrap it, Joe. Best new idea right now from Blackstone is?
We buy companies, we buy real assets, we invest, we don't
Residential housing still? You're the biggest landlord in the United States.
I think logistics is going to continue to be a strong secular trend, not only here in the United States, but all throughout Europe. That Amazon effect has done a ton to disrupt traditional retail. We know it, and we're in early innings in that.
And I think we had a $12 billion warehousing deal a couple months ago. Prologis, somebody else. Joe, great stuff. Jay-Z, excuse me.
Yeah, come on.
Thank you.
Thanks, guys.